All right, let's talk about what the heck happened in the market back in mid-October 2025. There was this sudden shock that hit, and for a minute, it felt like we were seeing a ghost of 2008. But was it really? Let's dig in and perform an autopsy on this panic to see what was really going on.
So boom, October 16th. This is where it all kicked off. Seemingly out of nowhere, the regional banking sector just went into a freefall. We're looking at the KRE fund here, which tracks these banks, and it plunged over 6% in one day. That was the biggest drop in months, and it just vaporized billions of dollars in value, sending this huge wave of fear across Wall Street.
So you got to ask, right? Why did this one little corner of the market just collapse? What was the trigger? And, the really big question on everyone's mind, was this the first tremor before a much bigger earthquake? Were we staring down the barrel of another 2008?
To really get what happened, you have to understand that the market was already on edge, kind of walking on eggshells. And the thing that finally lit the fuse, well, it wasn't some complicated government report or a crazy algorithm. Nope. It was lit by just one phrase from one of the most powerful people in finance. And there it is. That's the line that did it. During JP Morgan's big earnings call, CEO Jamie Dimon dropped this cockroach theory when he was talking about some loan losses they'd seen. Now, he was probably trying to project strength to show his bank was ready for anything, but that is not what the market heard. The market heard a terrifying warning. This is just the beginning.
So what were these cockroaches that had Jamie Dimon so spooked? Let's do some investigating. Turns out they were two bankruptcies that, on the surface, didn't seem related, but together they exposed some really deep cracks in the credit markets.
Okay, so on one side you had Tricolor Holdings. They were in the subprime auto loan game, and they went under amid all these allegations of fraudulent data. That absolutely terrified lenders, because it meant the numbers they relied on could be totally fake. And on the other side, you had First Brands, a huge auto parts company funded by this murky world of private credit. When it went belly up, creditors were screaming that over $2 billion in assets had just, poof, vanished, gone. And this timeline just shows you how fast it all snowballed. You have the two bankruptcies hitting in September, then mid-October, Dimon delivers his cockroach warning, basically priming the market for bad news. So when just 48 hours later, a couple of regional banks report their own loan problems, the market didn't see isolated incidents. No way. It saw confirmation. The cockroach theory was real. Time to sell. The reaction was just immediate and brutal. Regional banks obviously got hammered, but the fear spread fast to smaller companies, the Russell 2000, because everyone knows they rely on those regional banks for loans. So where did all that money go? Well, people yanked it out and sprinted for the classic safe havens. Gold shot up to an all-time high, and investors piled into government bonds, which pushes their yields down. It was a textbook flight to safety.
Okay, so here is the most crucial point of this entire story. This panic, it didn't come from some new disease that suddenly infected the economy. No, this was the sudden, painful realization that a pre-existing condition, one that had been building for more than a decade, was finally reaching a critical stage. We are talking about the great zombie company reckoning.
So what in the world is a zombie company? It's a really simple but powerful idea. Think of it like a business that's on life support. It doesn't actually make enough profit to pay down its debt, the principal. It only makes enough to pay the interest, just to keep the lights on. It's not really alive, but it's not dead either. It's just shambling along, kept moving only by a constant IV drip of cheap, new loans.
So how did we get a zombie apocalypse in the first place? Well, it's a pretty simple three-step story. For a decade after the 2008 crisis, the Fed kept interest rates at basically zero. That created the perfect breeding ground for these zombies to multiply. And they did. Some estimates say they grew to make up a quarter of all U.S. companies, holding a staggering $2 trillion in debt. But then came the reckoning. The Fed jacked up interest rates to fight inflation, and all of a sudden, that cheap credit IV drip was gone. Their life support was switched off.
Now, this is where things get really weird, because at the exact same moment that this regional bank panic was unfolding, something completely different, completely opposite, was happening in the broader stock market. It was a total disconnect, a true tale of two markets.
So, market number one, this was the fear market. It was completely obsessed with the bankruptcies, the fraud, that cockroach warning. It was bracing for a nasty credit crunch that could kill small businesses, and it was hitting the sell button, hard. And yeah, you can see it right there. The performance tells the whole story. Regional banks and small-cap stocks were deep in the red. This part of the market was preparing for the worst, battening down the hatches.
But then you had market number 2. And this one, it was looking right past all that drama. It was focused on the big picture. Inflation was finally cooling off, which meant the Fed could start cutting interest rates again. You combine that with this massive ongoing optimism around AI, and this market was living in a perfect Goldilocks world. Not too hot, not too cold. It saw a soft landing ahead.
And would you look at the result? While the regional banks were in a nosedive, the major indexes, the S&P 500, the Dow, they were soaring. In fact, just a week after that sell-off, the broader market was hitting brand new all-time highs. It was a complete split personality.
So, how can the exact same news, the Fed signaling rate cuts, cause two totally opposite reactions? Well, it's all about your point of view. For the huge tech companies that dominate the S&P 500, Fed rate cuts are pure gold. It means cheaper money and makes their future profits look even bigger. That's a huge buy signal. But for the banks, the reason the Fed is cutting rates, a slowing economy, is a massive red flag. It means their customers are going to start defaulting on loans. For them, it's a sell signal.
So let's land the plane here. When you put all these pieces together, what's the final verdict on the October shock? Was it the beginning of the end, or was it something else entirely?
All right, so here are the key takeaways you really need to remember from all this. First, and this is the big one, this was a crisis of credit quality, bad loans, not a crisis of bank solvency like in 2008. The banks themselves weren't about to fail. Second, this zombie reckoning is painful for sure, but it's also a necessary cleanup after a decade of easy money. You got to clear out the weak companies eventually. Third, the real rot seems to be in those less regulated corners of finance, private credit and so-called shadow banking. And finally, get used to this tale of two markets because it's probably here to stay. That means continued choppiness for banks, even while the big tech sector might stay strong.
So in the end, the October shock wasn't a systemic meltdown, but man, was it a warning shot. It was the first painful wave of a long overdue reckoning for the weakest parts of our economy. We've now seen the first economic zombies fall. And that leaves us with one crucial and kind of scary question. Who's next?